Welcome back to The Deep Dive, your shortcut to being truly well-informed. Today, we're taking a magnifying glass to a bit of a paradox, really. The Q2 2025 earnings call from a major digital infrastructure player. On paper, the results looked solid, revenue beat, dividend raise, strategic shifts happening.
Right.
Yet the market reacted with a shrug, maybe even a dip. So we're going to unpack why that disconnect might have happened.
Yeah, dig into the details.
Exactly. Dissect management's strategic plays and consider the long-term implications for the sector and, of course, for your portfolio. This call definitely sparked a lot of questions, and we're here to try and answer them.
Indeed. We've gathered all the key data points from the earnings discussions, the press release, everything. And our mission today is really to distill what's truly important, give you the insights you need without that usual information overload. What's really fascinating here is how the company is balancing strong operational performance with a pretty significant strategic pivot.
Right.
And how the market chose to interpret that.
It's interesting.
That's interesting.
Absolutely. So let's maybe start with the immediate numbers from Q2, the headline figures. The company really delivered on the top line, revenue hitting nearly $699 million.
$698.98 million, to be precise.
Right. And that's a notable 4.3% beat against consensus expectations, marks approximately 3% year-over-year growth.
Decent growth.
And on the non-GAAP AFFO per share adjusted funds from operations, they came in at $3.17. That was a positive 0.6% beat. And for listeners maybe less familiar, AFFO is often seen as a more accurate measure of cash flow for these kinds of asset-heavy companies than traditional earnings.
Exactly. So that AFFO beat suggests, healthy operational cash generation.
Yeah.
But while those top-line figures were strong, and the AFFO beat is certainly encouraging, it's worth noting that GAAP EPS did slightly miss, came in at $2.09 versus an expected $2.11.
Okay, a slight miss there.
A slight miss. However, adjusted EBITDA saw a respectable 1.8% year-over-year increase to $475.5 million. And tower cash flow was up 1.4% to $511 million. So this speaks to the underlying operational efficiency, the stability of their core business, really.
And, they're not just growing the operations. They seem to be showing a real commitment to shareholders, too.
Yeah, that was clear.
They raised their quarterly dividend by a pretty significant 13% to $1.11 per share and repurchased nearly 800,000 shares, $172 million worth, at an average price around $215. That's a pretty clear signal of confidence, wouldn't you say?
It is a strong signal, yeah.
Yeah.
Especially that dividend increase, quite chunky. However, despite these mixed but, largely positive results, the immediate market reaction was, a bit nuanced.
Right, that disconnect we mentioned.
Exactly. Shares experienced some downward movement in post-market trading and then continued to see a dip in the subsequent session. Which raises that important question. Why the disconnect? What are investors really focusing on when these numbers hit the tape?
That's precisely the puzzle we're looking to solve. So despite those largely positive numbers, a mixed market reaction. That brings us to the crucial part. What did management actually say about their financial outlook for the rest of the year? Did it justify that initial investor hesitation? The CEO, Brendan Cavanagh, emphasized that network investment momentum is building. He said they expect to benefit from it for many years to come. That's a pretty bold statement.
It absolutely is long-term conviction right there. And that confidence is reflected directly in their lifted full-year 2025 outlook across all key metrics, too.
Okay.
Revenue is now projected between $2.78 billion and $2.83 billion. AFFO per share guidance moved up now between $12.65 and $13.02. And adjusted EBITDA is now anticipated to be between $1.91 billion and $1.93 billion.
So meaningful upward revisions across the board.
Yeah, you don't typically see guidance lifted like that unless management feels very confident in their underlying trends.
What really jumped out at me, though, was their services revenue guidance. Hiked by approximately 20%. That seems huge.
It is huge.
What's driving such a significant jump? And what does that tell us about the underlying demand from U.S. carriers?
Well, that's driven directly by accelerated U.S. carrier installations. They're just getting more work done faster. Domestically, their organic leasing grew 5% gross, but only 1% net. And the key insight here, which management pointed out, is that new colocations.
So new tenants on the tower.
Exactly. New tenants setting up equipment. Those are actually outpacing amendments, which are just upgrades by existing tenants. Now, while new colocations delay revenue recognition a bit compared to amendments, because it takes time to deploy new gear, they're actually building a much stronger, more diversified future revenue base.
Ah, okay. So it's like a longer-term investment indicator.
Precisely. It signifies a long-term investment by carriers into new infrastructure, not just tweaking existing setups. If you connect this to the bigger picture, it suggests sustained demand for new points of presence, which bodes extremely well for the company's future revenue streams. It's a kind of delayed gratification for investors, perhaps.
Okay, short-term patience for long-term gain. Makes sense. But it wasn't all clear sailing, was it? Management openly acknowledged some headwinds.
Right.
Specifically, elevated churn. What's the story there?
Yeah, the elephant in the room, I suppose, was the ongoing Sprint consolidation churn.
Still working its way through the system.
Still working through. It accounted for $11 million in Q2, and they're projecting it to be around $52 million for the full year 2025. And just for context, this is the ripple effect from the T-Mobile and Sprint merger, right? T-Mobile's decommissioning Sprint's old network gear, so those contracts get terminated. They also anticipate approximately $50 million more in Sprint-related churn in 2026, and then about $20 million thereafter. So it tails off.
Still a multi-year impact, though.
It is. And then another international challenge was highlighted: the Brazil Oi bankruptcy exposure. That contributed an extra $5 million in churn this quarter.
Okay.
But while these are definite headwinds, the company was transparent in quantifying them. It suggests they are largely factored into that forward guidance we just talked about.
Right. So known knowns, hopefully.
Hopefully. It's a necessary, albeit, temporary challenge for the long-term health of their key customers in those markets, like T-Mobile consolidating.
It's almost like a company going through a painful but necessary detox. You shed the legacy churn to emerge stronger, hopefully.
That's a good way to put it.
Beyond the numbers, the strategic portfolio repositioning was a huge theme on the call. What did they actually do on that front?
Yeah, this is where their strategic vision really comes into play, I think.
Yeah.
They closed on over 4,300 Millicom towers in Central America, and earlier than anticipated, too.
Millicom, okay.
Yeah, this is a $550 million investment. It now positions them as the leading tower operator in that region. Big move. And these towers come with attractive 15-year US dollar-denominated contracts. Plus, build-to-suit arrangements, meaning Millicom is committed to using them and building new sites with them.
So built-in growth potential there.
Definitely. And this early closing even contributed $16 million to the Q2 revenue increase. The remaining 2,500 sites are expected to close by September 1st. So pretty soon.
So a significant expansion into a new, potentially high-growth market. And what about the other side of that coin? What were they shedding?
Right. Concurrently, they announced an agreement to sell their Canadian tower portfolio.
Getting out of Canada.
Getting out of Canada. It was a subscale asset for them, meaning, it wasn't really large enough to achieve significant economies of scale. It generated about $27 million Canadian in annual leasing revenue and $15 million Canadian in after-tax cash flow. So not insignificant, but small relative to their overall size.
So they're taking a smaller, less impactful asset and basically trading up for that leadership position in Central America.
Exactly. And the sale, expected to close in Q4, is anticipated to be immediately accretive to AFFO per share.
Immediately accretive. Okay.
Yeah. And it'll free up capital for share buybacks and potentially debt reduction. Management also indicated the valuation achieved in this private transaction was, quote, significantly higher than their public company valuation implies.
Oh, interesting. That's quite a statement, isn't it? Implying the market isn't fully appreciating the value of these tower assets.
It really highlights the perceived value of these infrastructure assets in private markets versus public sometimes. And it seems like a smart move to optimize their portfolio, focus where they can lead.
And speaking of financial flexibility, a really crucial development came just before the earnings on July 30th.
Ah, yes, the rating upgrade.
S&P upgraded the company's corporate credit rating to BBB. They achieved investment grade status.
That's a game changer.
Huge deal, right? Provides much greater financing flexibility, potentially lower borrowing costs in the future. They can tap into a wider pool of capital now.
Absolutely. Opens up the investment grade debt market.
Okay, shifting back to the big picture demand drivers. The CEO pointed to sustained 5G densification, accelerating fixed wireless access rollouts, and even increasing AI-driven traffic as key long-term demand drivers for their infrastructure. And this marked the 6th consecutive quarter of rising bookings, which sounds really impressive.
It is impressive. 6 straight quarters.
Can you break down what those trends actually mean for our listener? densification, fixed wireless, AI traffic.
Sure. So 5G densification basically just means packing more network capacity into existing areas. Think of it like adding more lanes to a highway to handle increased traffic, giving you faster, more reliable connections.
Okay.
Fixed wireless access, or FWA, is where carriers like Verizon or T-Mobile use their 5G network to deliver high-speed home internet, directly competing with traditional cable or fiber.
Got it. Home internet over the air.
Exactly. And AI-driven traffic refers to the massive data demands that artificial intelligence applications are expected to create. All that processing, all that data movement needs robust network infrastructure.
Right. So these are all huge tailwinds for tower infrastructure. And those rising bookings confirm that the demand isn't just theoretical, it's actually happening now.
It's translating into business, yes.
And it's not just about what the company is doing internally. There seem to be significant external tailwinds, too. What's the deal with the FCC's spectrum auction authority being reinstated?
Yeah, that's a potentially significant catalyst. The reinstatement includes 800 megahertz of additional spectrum becoming available. And importantly, 100 megahertz of that is slated for auction by mid-2026.
Okay, why is that crucial?
Because new spectrum almost always means carriers need to install new equipment, new radios at cell towers to actually use it, which directly benefits this company.
Right. It's like new roads being open, you need new vehicles, new radios to drive on them.
Precisely.
And it's not just new spectrum. There was mention of the permanent reinstatement of bonus depreciation. How does that help?
Right. That's expected to improve liquidity for their carrier customers. It could potentially lead to greater investment in their networks. It's essentially a tax break that allows carriers to deduct a larger portion of their capital expenditures upfront, which frees up cash.
So more money in the carriers' pockets that they could potentially pour back into infrastructure upgrades?
Exactly. More cash available often translates to more spending on network upgrades and expansion, which is generally good news for tower companies. And importantly, the company confirmed that this densification activity is broadening out. It's not just one or two major carriers anymore. All major customers are showing increased engagement.
That's good diversification of demand.
It indicates a more diversified and robust demand environment, yeah. Less reliance on any single customer's spending cycle.
Okay, one more potential disruption maybe. What about the growing satellite business? LEO projects low Earth orbit satellites like Starlink. Are those a threat to traditional macro tower sites?
Management addressed this. They view these LEO systems as more complementary solutions. Good for hard-to-reach, economically challenging areas like very rural spots.
So not direct competition for most areas.
Not for the core business, they argue. They anticipate macro tower sites will remain the primary and, frankly, the most efficient way to deploy new spectrum, especially where the population density is, even at higher frequencies. Think of LEOs providing broadband to extremely remote areas, maybe boats or planes, while macro towers are still essential for the dense urban and suburban areas where the vast majority of data traffic actually occurs.
Okay, that makes sense. So if we connect all this back to the investor context, let's look at their balance sheet and capital allocation strategy. The company ended the quarter with about $12.7 billion in total debt, $12.3 billion in net debt. Their net debt to adjusted EBITDA leverage ratio stands at 6.3x, which, they noted, even with the incoming Millicom assets factored in, remains near historical lows for them.
Right, they've managed leverage reasonably well. And their debt structure is also quite favorable, especially now. Weighted average interest rate is only 3.7%.
Wow, in this environment.
And 97% of it is fixed rate. So that significantly reduces their interest rate risk compared to companies with more floating rate debt. Their next significant debt maturity isn't huge either. It's a manageable $750 million due in January 2026.
Okay, so some runway there.
Yeah. And management reiterated what they call a balanced capital deployment pledge, basically alternating between share repurchases, selective M&A like Millicom, and opportunistic debt reduction.
And they still have quite a bit left under their share buyback authorization.
They do. $1.45 billion remaining. That's substantial and provides, a potential strong floor for the stock price if they choose to deploy it aggressively.
And that investment-grade credit rating we mentioned, that's a really key development here, isn't it?
Absolutely. It opens doors to the investment-grade debt market, particularly for unsecured paper, which could potentially lower their financing costs even further down the line.
It's a long-term structural advantage they've now secured. Kind of proves their financial health to a wider range of investors and lenders.
Definitely. And if we look at the long-term growth trajectory they're painting.
Yeah, what are they guiding to longer term?
The company outlined a long-term AFFO per share growth rate in the mid to high single digits. But that's once the headwind from eventually refinancing some of that very low-cost 3.7% jet at potentially higher interest rates normalizes.
Ah, so there's a refinancing headwind to get through first.
There is. That normalization is expected over several years as their current debt tranches mature. So overall, the narrative seems to be shifting from maybe aggressive high-growth M&A, which was common for these companies a few years ago, towards more disciplined balance sheet optimization and enhanced shareholder returns.
Makes sense.
With a focus on executing the integration of new assets like Millicom and just leveraging these ongoing industry trends we discussed, it feels like a maturation of their business model, perhaps.
Okay, so what should investors really be watching for next? As we look out over the next few quarters, what are the key catalysts or milestones?
Well, key catalysts ahead definitely include the full Millicom deal. It's close that's expected by September 1st. That'll bring more revenue and finalize that strategic positioning in Central America. Also, watch for the completion of the Canada sale in Q4. That should be immediately accretive to AFFO, as they said.
Right.
And of course, the next big data point is the upcoming Q3 results and guidance, probably in late October. That will give the next update on their trajectory, how that churn is tracking, how the integration is going.
Any external things to watch?
Yeah, keep an eye out for further visibility on those spectrum auction timelines we mentioned, and any potential investment-grade debt issuance. If they tap that market soon, it could signal lower financing costs potentially sooner than expected.
Okay, we've covered a lot of ground today, a lot of detail, and now it's time for our This Is Not Financial Advice segment.
Yes.
This is where we propose an outrageous but plausible trade idea based on our deep dive into this earnings call.
Right. And given the market's, let's say, initial lukewarm reaction to what seems like pretty solid news and guidance, well, we believe there might be a compelling opportunity here that the broader market is perhaps missing.
Okay, lay it on us. Our thought is, consider a long position in this digital infrastructure company's stock, maybe aiming for a price target somewhere in the mid to 60s range. The immediate post-earnings dip appears, to us anyway, like a classic profit-taking move, or maybe just short-term noise rather than a fundamental shift in the underlying thesis.
Yeah, it feels like the market might be overly fixated on the sprint and OI churn, which, okay, it's a real headwind, no doubt, but it's quantified, it seems manageable, and it's largely absorbed into that lifted guidance.
Exactly.
What's potentially being overlooked, or at least underappreciated, is that clear and accelerating domestic organic growth driven by those new co-locations, remember?
Yeah.
The delayed gratification part.
Right.
Plus the immediate AFFO accretion coming from the Canada sale. And then just the robust long-term structural tailwinds. The 5G densification, the fixed wireless expansion, new spectrum deployment, even that nascent but potentially huge AI-driven traffic demand. This isn't just a short-term cycle. It feels like a fundamental shift in how the world uses data, and they provide the backbone for it.
And that strategic portfolio rebalancing, shedding the subscale Canadian assets for market leadership in Central America, that, combined with the newfound investment grade rating, significantly de-risks the capital structure, doesn't it? And dramatically improves future financing costs or options.
It really does.
This company seems to be executing on a pretty disciplined capital allocation strategy. You see it in the dividend increase, the ongoing share repurchases, the smart M&A.
So the bet here essentially is on the market eventually appreciating that lifted full-year guidance, appreciating the underlying durable demand for wireless infrastructure, demand that will, we think, ultimately overcome the short-term churn noise and maybe some lingering interest rate anxieties. This company is building a foundation for long-term value, and it feels like the market hasn't fully caught up to that quite yet.
Okay, so to recap, this quarter really shows a company strategically repositioning its portfolio, benefiting from pretty robust domestic demand drivers, and, crucially, lifting its full-year guidance. While they're navigating some definite short-term churn, its balanced capital allocation and improving financial flexibility, significantly boosted by that investment-grade rating, seem to lay a strong foundation for future shareholder value. Agreed. But remember, everyone, this deep dive is for informational purposes only. It is absolutely not financial advice. We've covered a lot today. What really stands out to you from this earnings call? Thinking about that shift from maybe high-growth M&A towards more disciplined balance sheet optimization, how much room does this company actually have to surprise on shareholder returns, especially if they successfully deleverage further and continue to see this organic growth accelerate? Interesting question to ponder. We welcome your insights and questions on that. Until next time, stay informed.